Good afternoon, everyone. Welcome to the ABM4Policy seminar series. It is a pleasure today to have Mattia Guerini with us. He recently joined University of Brescia, where I think he's an assistant professor. Correct me if I'm wrong, Mattia. Today we'll talk about governance structure, technical change, and industry competition. Just a reminder to everyone, we are recording the seminar. It will be made available on the YouTube channel of ABM4Policy later on. Feel free to type your clarificatory questions in the box. I'll manage the questions, and then please ask more substantial questions at the end of the seminar. Mattia, the floor is yours.
Thanks a lot, Marco, for this nice introduction. And well, as you said, I recently joined the University of Brescia, and this paper, anyway, has been largely developed while I was at my old university, which was the University of Côte d'Azur. And it's a joint work together with Philipp Harting and Mauro Napoletano. So it is a project stemming from two European research projects. One is the project HOMENTS, which I was leading under a Marie Curie action. And the other is the project Growing Pro, which is a project, a larger Horizon 2020 project coordinated by the Scuola Superiore Sant'Anna, and when both Philipp and Mauro are collaborating. So it is a pleasure to present this paper, which is not on monetary policy. So even if it's organized by Bank of England, but is more on the industrial side of the economy in a financialized world. So we try to look at the link between the governance structure and the industry dynamic, in particular technical change and the competition. So we start from the empirical evidence, from two empirical evidences. One is an empirical evidence over the time dimension. As you can see, this is the percentage of ownership of firms belonging to the US stock market, so listed in the US stock market. And this is the percentage of ownership of institutional investors, where institutional investors are both banks and other kinds of financial institutions. And we can see that over the past 60, 70 years, a huge increase in the percentage of ownership has been negated by these institutional investors. So from a percentage which was around 10% up to 75% in 2006, which is the last year available from this nice paper that we have found. So there is a huge increase in the ownership of firms, which is not directly in the hands of the people controlling it. So let's say the founder or the owner, the controller of the firm. And secondly, during the past decades, many listed firms started to do a practice which for sure is helpful for using the liquidity that they might stock, which is the usage of share buybacks. So firms are buying back their outstanding share from the market. And this, of course, has an impact on the share price of the firm. So whether these two phenomena are directly connected by some causal link, it is far from clear from this empirical evidence. But we try to develop a model in order to disentangle the effects and the possible relations between these two events. And we believe that one of the forces that might determine these two trends and these two stylized facts, let's say, is mediated by the governance structure of the firm. So most of the strategic decisions that a firm make, it is undisputed that they do depend on the type of governance structure the firm has. So where governance structure here can be a broad term, which covers both the ownership of a firm, so who controls the firm, who owns the share of the firm, but also the kind of managerial independence and the compensation mechanism of the managerial board and of the other figures working into the firm. So governance structure, it's a broad term in this paper. But then we will see that two dimensions that we mostly are going to control is directly the ownership structure and the managerial independence. And of course, among the most important strategic decisions that firms make, there is the allocation of financial resources to different investment projects. So, and in a modern economy, like let's say the United States or the European Union, where there are many financial opportunities, the problem of many firms has turned. So in the past, firms used to decide between different real investment projects. So should we invest in technology A or should we invest in technology B? Nowadays, the financial allocation problem has been turned into a decision between the real and financial investment. So should I allocate my resources to some real investment in a new technology, or should I allocate my resources through some financial investment and get the return? So let my funds be possibly driven by the market rather than by my decision of real investments. And the literature has taken into account a part of this problem. So in particular, the literature has mitigated how the firm takes this, has investigated how the firm takes this decision when there are conflicting interests between shareholders and the management. So when the shareholders are institutional investors, not looking at the firm decisions often, and leaving the management alone, choosing what is correct for the firm, what is the best for the firm. And in particular, here we refer to a stream of literature derived after Jensen and Meckling, a seminal paper. And the main aspect is that stock payments are also given to the managers as part of the remuneration. So trying to align the managers to the shareholders might lead to beneficial results, according to this literature. What this literature has less investigated, so to a lower extent there is a gap in this literature, is on the relationship, on the conflicts between different kind of institutional investors. So as a matter of fact, the empirical literature realized that the institutional investors can be very heterogeneous. So there are institutional investors in particular, which are long-term oriented investors. So they would like the firm to continue deliver profit quarter after quarter or year after year, while there are other kind of institutional investors whose main interest is only to get the profits as soon as possible via an increase in the stock price of the firm. And these two kinds of investors are clearly conflicting when they have to take a strategic decision for the firm, where we should invest our money, where we should invest the liquidity of the firm into a real project, which maybe delivers profit after 3, 4, 5 years, or should we invest in financial markets, which might lead up the stock price and we might get some profits by reselling our shares after 4, 5, 6 months. So this difference in the investment horizon of this investor might lead to huge conflict when strategic decisions have to be taken. So overall, what I just told you about this empirical literature is that there are many interactions between all these aspects. So the governance structure, the investment decision, as well as the management payment schemes. But it's very difficult by using an empirical approach to disentangle this effect. And this is the reason why we have tried to develop an agent-based model. So we highlight, first of all, some stylized facts, so some, let's say, testable hypotheses, which we can try to derive within a model. And at the micro level, we have highlighted two main stylized facts. So the first is the fact that a strong presence of impatient investors has a negative effect on R&D activities. And the second stylized fact is that the stronger stock-based remuneration to the management positively impacts on the amount of share buybacks. At the aggregate level, instead, there is also another aspect which is worth to be investigated. So while most of the literature concerning about governance structure is focused on the micro effects of the governance structure, there is another stream of literature, so which follows, let's say, by Aguillon and co-authors in the mainstream literature, of course, on the relationship between competition and innovation. And the fact is that the governance structure, by affecting individual firms' decision, might also impact at the aggregate level on the evolution of a whole industry. And so we have highlighted a third stylized fact, which we believe might be mediated by the presence of a specific corporate governance structure. And in particular, this stylized fact is on the relationship between competition and innovation. And this stylized fact is about an inverted U-shape relationship between these two variables. So the aim of our paper, as I told you before, is that of disentangle these effects and try to study the interaction that these forces might bring about, not only at the micro level, but also at the aggregate level. And we have separated this paper into two parts. So we have two models, which are one, a deterministic and static version of the other. So the first model, which I'm going to present here, it's a extremely simple, probably unrealistic representation of what is going on, but allows us to study the investment behavior of a single firm in a very precise manner, where we are also able to derive some analytical results. Then, on the second stage, we develop a fully fledged agent-based model, where we have, of course, dynamics, we have heterogeneous agents, and we have a stochastic framework, which integrates the first one, but allows us to study numerically the relationship between competition and innovation. So I will start from the very first one, which is relatively simple. But if you have a clarification question, don't hesitate. I can stop and I can explain you more. So the model is it's static, but we divide the model into three periods. So we have a unique firm which lives for 3 periods, time 0, 1, and 2. And the firm is controlled by 3 agents. So there is the short-term investor, or a number of short-term investors, a unique long-term investor, which we can say is the founder of the firm, and together they hold n shares of the company. Or we can think about fractions. L is the fraction of shares held by the long-term investor, and 1 minus L is the residual, is held by the short-term investor. And they have contrasting objectives, because the short-term investor aims at selling the share in period 1, so halfway, while the long-term investor wants to hold the share until the firm is liquidated in period 2, and obtaining the final value of the firm. The third actor is a manager, which is only in charge of the operational decision, but he also has an impact on the final decision on whether to invest into real activity or whether to invest into share buybacks. So the manager gets a reward which is composed of three parts. So the first is a fixed income, WF, which is paid in period 1. It can also be equal to 0 without loss of generality. Then the manager gets a bonus, but the bonus is only paid at the end, so in period 2, and is a fraction gamma of firm profits or of the final value of the firm. And he also receives at period 0 beta restricted shares, that he can sell at period 1. So also the manager is in contrast, actually. The payoff function of the manager, we hold a contrast between long-term profits or short-term monetization of the stock options. So we have so the firm has a budget, and the budget, which can be normalized to 1, should be allocated between either buybacks B or R&D investment, which is the complementary part 1 minus B. The difference between the two is the fact that the R&D yields a profit at period 2, and so we have a profit function which depends on x, which is equal to 1 minus b, where p prime is greater than 0 and p second is smaller than 0. So the larger the R&D investment, the larger the profit, and the marginal increase, of course, gets lower and lower. So on the other side, we have the share buybacks, which it's an operation which involves the repurchasement of B outstanding stocks at period 1, which means that these stocks are bought from the short-term investor, which hold these shares at period 0. So the investor compensation is equal to the discounted terminal value of the firm, as it's standard in this financial literature. So for a given buyback volume, at T0, we can compute the present value of holding the shares in a period T1 and selling this share. So the value of the share is equal to Q, which is a discount factor, 1 minus gamma, which is the fraction of profit not given as bonus. So remember that gamma is the bonus, pi is the profit of the firm, and therefore this is the residual profit after the bonuses to the managers have been paid, and Q is a discount factor, which is divided into the number of shares which are present. So N shares plus beta shares which are paid to the manager minus the number of shares which are bought back by the firm. So one can find a solution. Basically, we have to bring V1 on the left-hand side, and then we can find a solution for V1. And we observe that we have this function, which is a positive function with respect to B here, but a negative function of B here. So what is the optimal solution of this problem? Well, we first of all, we set the problem and we have a trilateral Nash bargaining. So we have three actors: the manager, the short-term investor, and the long-term investor. And each of them has a bargaining power, which is given by the exponent related to the actor. So psi is the bargaining power of the manager, phi s is the bargaining power of the short-termist, and phi l is the bargaining power of the long-termist. And so by solving this problem for B, we can find the optimal level of buybacks that a firm should carry out, and consequently also the optimal level of R&D. So the three payoff functions which I've described before are also here expressed in mathematical terms, but the unique condition is that these three parameters should sum up to 1. And phi s and phi l are also given by the ownership structure. So now I'm not going to present you all the derivations of the result, but what I'm going to discuss is the effects that some parameters might have on the final outcome. So in particular, we try to look at comparative statics exercises. So we focus on the share held by long-term investors. So when the ownership is relatively long-termist with respect to vis-a-vis short-termist, the manager influence, so how much independent a manager is, and then with respect to the payment scheme of the manager. So beta, the number of stock paid to the manager, and gamma, the bonus level. And we find basically 4 results. The first is fully consistent with the first stylized factor presented you before, so that when the share of long-term investor increases, the firm devotes more resources to R&D rather than to buybacks. Okay, this might be not a surprising result, also given the payoff functions that each agent has. The second one is instead a bit more complicated, and it depends on the manager's autonomy. So when the manager becomes more independent, it depends on whether the manager is paid by substantially by stock options, or whether he is paid by bonuses. So when the stock-based remuneration is high, then more autonomy also increases the buybacks. So the manager is more aligned with a short-term investor. Instead, when a stock-based remuneration is low, the manager resembles a long-term investor, and therefore the share buybacks tends to decrease with this parameter. Then the third result is also probably not so surprisingly, given the second, so that an increase in stock-based remuneration beta aligns the incentives of the manager with the incentives of a short-term investor, and therefore increases the amount of share buybacks. So B star is larger. And finally, we have the last result with respect to the bonus payment, which they decrease the share buybacks only in specific conditions. So only when, first of all, the manager already has a high share-based remuneration. So when beta is sufficiently large, there is a threshold of beta basically below which, above which an increase in bonus payment decreases the share buybacks. However, there is not only this effect, because the amount of shares beta which are paid out to the manager also impacts, if you go back and you look at this equation, also impacts on the share price. And so this also impacts on the payoff of the long-termist and of the short-termist. So this is why this relationship can become non-monotonic and depends both on the values of beta and on the original value of gamma. So a marginal increase of gamma might either bring to a positive impact on buybacks or to a negative impact on buybacks. Now, all these results are useful in order to understand what an individual firm can do in this framework. But they are completely unfit to understand and to analyze how the governance structure affect the overall industry evolution. And therefore, we decide to take this framework and bring it into a more complex dynamic model. So in particular, we have a model of industry dynamics, one which probably many of you know. I mean, some equations are really a standard nowadays in industry dynamics agent-based models. So we have the demand of a single firm I, which is given by the monopolistic competition equation. So it depends on the market size. And there is an inverse relationship between the price of a firm and the demand that this firm receives. So here below, we have basically the weighted average of a weighted average of all prices. And at the numerator, we have instead the price of a single firm. So that the larger this price is, the lower the quantity demanded to this firm I. Then the firm set prices according to a markup rule, which is very standard. And the wages are proportional to the average industry productivity. So prices are firm specific, wages are industry specific. And one can then compute the operating profit, so the market profit of a firm, which are equal to the unitary revenue minus the unitary cost times the quantity sold minus the fixed payment, the fixed wage of the manager. So these are the operating profits, and these pi star are the market profits. So overall, firms can also accumulate profits, and this goes into the net worth of a firm. Firms with a negative stock of liquidity, they exit instead from the industry and they are not replaced. So there is an original number of firms which can only eventually decrease and decline if some firm goes out of the market. So the innovation process is also pretty standard. So we have a stochastic process where the probability of making an innovation depends on the amount invested into R&D. And when innovation happens, the productivity of a firm rises by a factor zeta, which is the productivity gain. And this productivity gain depends on the gap between the firm productivity level, AI, and the productivity frontier, A max. So the farther a firm can be from the frontier, the larger the jump that this firm is likely to make. So all firms, we treat these firms as listed. So they have NIT outstanding shares, which are traded in period T, and the number of outstanding shares varies over time. Why it varies over time? Well, because there are buybacks. So some shares might be retracted from the market because they are bought back by the firm. On the other side, the number of firms might increase over time because there are beta new restricted shares. So restricted share, they don't pay dividends, which are given every period to the manager of the firm. So the number of shares at a time T are equal to the number of shares in the previous period, plus the new shares which have been issued and paid to the manager, minus the amount which is bought back by the firm. And a fraction L of this outstanding share is held by the long-term investor, and 1 minus L is held by short-term traders. And these traders, they also have heterogeneous expectations about the future share price. So they have expectation on the share price, which depend on their optimism or pessimism with respect to the effect of buybacks. So optimist traders believe that buybacks have a positive impact on the share price. Pessimist traders believe that an increase in share buybacks might decrease the reputation of the firm and therefore the share price. So the stock price, I don't present all the equations because otherwise it would become too much complicated, but it's a standard broken ohms model. So it's an equilibrium price, if you want, when in a market with heterogeneous traders. And again, exactly as in our static deterministic framework, we have the trilateral Nash bargaining problem, depending on the payoff of the manager, of the short-termist and of the long-termist, and on the relative bargaining powers. So this is the budget constraint of the firm, the budget constraint, which means that the firm either invests into real investments or share buybacks, the liquidity that the firm has. And according to this choice, we are going to have a maximization of this objective function. So this problem can only be solved numerically. And in particular, we equalize the weighted returns from a marginal increase in the real investments and a marginal increase in the share buybacks. And this will give the optimal solution of I star and B star at every period. So in every period, we also have a numerical solution of this problem in order to determine the optimal amounts of investment and buybacks. So what happens into our model in every period? Well, first of all, the firm determines the dividends to pay, and with the residual sum, there is the network is allocated either to I or to B, according to the problem that we have just seen. Then the financial market opens. So given the level B star that the firm has decided, the firm repurchases the share, and the share price VIT is determined in the market for every firm I. Then we have the innovation activities. So given the optimal choice I star, there is the R&D which is carried out, and eventually the firm discovers the new productivity level and makes the production of the good. Then there is the good market activity. So according to the demand function, which we have seen before, and the pricing function, the firm realizes the market profits. And finally, the bonus on the market profit is paid to the manager. The manager also receives the restricted shares without dividends and the fixed income. So at the very end of the period, we just have a simple law of motion of the network, which will determine which firm survives and which firm instead goes out of the market. So the model is calibrated. We have used the standard method, the method of simulated moments, basically. So where y bar theta, it's the number of, it's a moment depending on the set of parameter theta that we have decided and we have used to calibrate the model. And y hat is instead the empirical target with respect to what we determine this calibration, with respect to which we want to replicate. So this y bar depends both on the number of Monte Carlo and on the number of periods in which we simulate the model, of course. So we have simulated the model for a very long run. And I will also discuss why we have done this. And the target variables that we have decided to match are three statistics with respect to the average productivity growth rate of the total industry, the average buybacks to R&D, and the average wide buybacks to dividend ratio. So these are all variables that we have in our model and that we can try to match. So overall, the calibration result is, let's say, quite satisfactory, meaning that our simulated values are quite close to the empirical target that we have decided to match. And here in parentheses, we also have the standard errors. And these empirical data, they come from different sources. But they are mostly, these two variables are related to listed firms. And instead, this variable is related to the total industry, because we decided not to focus on a specific industry, but to maintain the model quite general that can be applied to any industry in which R&D investment is important. So aside from these three statistics that we try to match, we have also observed that the model generates a quite concentrated industry. So we start with 25 firms, as you can see here, and the black line defines the number of firms which is present into the economy. So overall, we observe that more or less 3 or 4 firms remain active at the end of the period. So the industry is quite concentrated. And if you look at the Erfindel index, the remaining firms, more or less, they have a similar amount of shares, given the fact that the Erfindel index is slightly above 0.3. So this is a standard process. There is also the shakeout phase. So this is in line with, let's say, the Klepper industry dynamics, evolution of industry dynamics. And then we go to the simulation results, and in particular to the effect of the governance on the concentration and on the productivity growth. So here we have the governance and technical change. The governance here is measured in this triangle plot, where every point in this triangle gives a combination of percentages which sums up to 1. And according to the position, we have a managerial controlled firm where the manager is completely independent and the long-termists and the short-termists don't care of what's going on into the firm. Here we have instead a firm which is completely controlled by a long-term investor. And here instead we have a firm which is completely controlled by the short-term investors. So of course, these three corners are the archetypical structures, but what is much more realistic is what's inside here into the middle region. And then we have also three lines, which are three configurations with a specific level of managerial influence. So the red line is a low managerial autonomy, which is about 10%. The blue line, it's a intermediate managerial autonomy, 50%. And the black line is a high managerial autonomy. And along this line, we can determine a position like this one, where there is a 50% managerial autonomy, but the remainder of the firm is completely controlled by a short-term investor. And this point here, which is instead 50% managerial autonomy, but then the remainder is completely controlled by a long-term investor. And these three lines are depicted on the second panel of the graph. And what we can observe here is the ownership of the long-termist. So this point here, where the LTI is equal to 0, is exactly this point here, while this final end line is exactly this point here, where the long-termist is controlling the remainder of the firm. And what we observe is that as we increase the amount of long-term investors or the control of the long-term investors, we observe an increase in the productivity growth. So this is quite expected, possibly. What is not expected is the completely linear effect of the long-term ownership when the manager is sufficiently independent. And this is due to the fact that in our baseline calibration exercise, the parameters gamma and beta, which determine the payment structure, the payment scheme of the manager, are such that the manager is actually oriented toward a long-termist, a long-term investor. So the parameter gamma, the bonus payment, is larger than the parameter beta, the stock option payment. So the manager here is more similar to a long-term investor than to a short-term investor. And this is
Mattia, sorry to interrupt. Just to remind you that you have 20 minutes left for your presentation. Thanks.
Yeah. I will take other 5 minutes to discuss the results, and then I will leave space to questions, or 20 minutes only for the presentation.
In total.
Okay. So the second result is about the governance and the concentration. So I will focus only on the right graph. Again, we have the long-term ownership, and what we observe here is that there is a declining relationship between the concentration and the ownership by the long-term investors. So the more long-term investors control the firm, the higher the competition level that we observe. These results, however, doesn't always happen, and it strongly depends on the timing at which we study the industry. So we have seen before in the calibration part that we have calibrated our industry over 50,000 periods. So what I've been showing you here is the relationship at the steady state, so at the very end of the simulation. But the behavior is actually different depending on whether we study a young industry, a mature industry, or a steady state industry. So this is with respect to governance and technical change, where we observe that the qualitative implications are unchanged, but there is an important quantitative implication. So while at the steady state, it is sufficient that 50% of the firm is controlled by long-term investor to guarantee a high level of productivity growth, in the early phase of the industry, even when the long-termist is almost controlling all the firm, it is sufficient a small amount of short-termism to get a drop in the productivity growth of the industry. And with respect to concentration, instead, we observe a more interesting effect over the life cycle of an industry. That is, while at the steady state, we only have this declining relationship between long-term ownership and concentration. In the early phases, first of all, we observe that industries are less concentrated, but this we know since the first graph. But secondly, we also observe that there exists a non-monotonic relationship, and actually an inverted U-shaped relationship, between the amount of shares held by the long-termist and the degree of concentration. And why we have this effect? Well, there are two economic drivers, basically. So here we observe the difference in the expected productivity growth at the firm level between the market leader and the average of the 4 closest followers. So when an industry is dominated by short-termists, so a large proportion of the firm is controlled by investors, which are, let's say, speculators, which only they want a return in the share price over the short-term horizon, we observe that the market leader is expecting a larger productivity growth with respect to the followers. And this larger productivity growth expected even increases over time. So the market leader invests more and the industry concentrates even more. However, when we have a long-term domination, this effect is actually reversed. So the leader expects a lower growth of productivity vis-a-vis the neck-and-neck followers. So the neck-and-neck followers have higher incentives to invest into R&D with respect to the market leader, and this might lead to a catch-up dynamic into the markets and to higher competition. So this is due to these two components. So remember that there is an increasing concave relationship between expected productivity growth, which is this term here, and the R&D investment. And there is a decreasing convex relationship between the size of innovation jump and the productivity. So the first effect dominates when the governance is more short-term oriented. And this leads to a preemption dynamics. The market leader invests more than the followers, innovates more, and this generates a higher expected productivity growth for the leader. When the governance instead is more long-term oriented, there are many firms which are doing R&D, and the second effect dominates. So since I am the market leader, I will develop a technology which will give me a lower jump, and my followers will instead be able to emulate me and maybe do even better. And they will overcome my productivity and they will become the new market leaders. And this will generate a leapfrogging dynamics. So the final aspect that we analyze is a joint analysis of these two forces. So we have competition on one side and productivity growth on the other, so technical change. And there are several studies by Guion, Griffith, Van Rienen, and co-authors, which describe the presence of an inverted relationship between these two forces. And they try to explain this relationship by using rationality of firms, of firm leaders and followers in their investment decisions. What instead we find is that this aggregate effect, it's actually a composition effect. So rather than studying a unique industry, we simulate many industries, so a population of industries, each of them characterized by heterogeneous governance structure. So we go back into this space and we sample a number of these points and we simulate a number of these points for many times, also giving them different parameters, and in particular, different parameters of the bonus, of the shares held by long-term investors, and the manager autonomy. And then we pool all the results over the competition and productivity growth space. And what we find is that this relationship can be negative or can be positive, depending upon the stage of the evolution of the industry. So in the early phases, this relationship is negative, while in the late phases, this relationship is positive, and pooling all these heterogeneous results together leads to this inverted U-shaped relationship between competition, as measured by Guerini and co-authors, and productivity growth. So this inverted U-shaped relationship, according to our view, is not the result of the rationality of the individuals and their decision to invest or not, but it's mostly an aggregation effect of evolutionary forces. So let me go to the conclusions, and then I will be here for questions. So what we find is two main results. So the first is this non-trivial inverted U-shaped relationship between technical change and industry concentration. And this relationship, I mean, this is discussed into the paper, but I didn't go through that in this presentation. When the manager is sufficiently independent, partly this relationship breaks down. And then there are two transmission channels for this result. So first of all, there is this positive monotone relationship between the amount of long-termism and the productivity growth. And secondly, the decreasing or inverted U link between the long-term investors and the market concentration, so the Erfindal index. So the final message is a policy message. I mean, we didn't experiment yet with this model any policy exercise, which might come up in later papers. But what is the holy grail of policymakers in industry dynamics? Typically is the combination of fast technical change, which leads to economic growth, and high level of competition. And according to our results, this can be achieved only under specific configurations of parameters, which then determine the governance. So first of all, there should be a sufficient proportion of long-term investors. So we have seen at the beginning that there is a huge trend in the amount of institutional investors, and there is the need that this institutional investor must be long-termist in order to achieve this policy objective. And secondly, corporations, they should provide the right incentive to the manager to achieve these results. First of all, through a remuneration scheme which introduces a link between profits and the manager's salary. So in particular, by giving bonuses rather than stock options. And secondly, once you have constrained the management with this kind of payment scheme, you should give sufficient autonomy to the manager to neutralize the influence of institutional investors, which only care about a short-term gain and a short-term increase in the share price of the firm. And a final aspect, a final warning is that all these results are even more important when one takes into account the evolution of the industry. So if one studies these effects at the steady state, these effects might seem minor, but once these effects are studied throughout the early phases of the industry, one can also find that these results are quantitatively more important. And this is it. This is what I have to say about this model.
Thank you very much, Mattia, for the presentation. So if anyone has questions, please, I think you're also welcome to directly unmute yourself, maybe ask them. There haven't been many. So Mark, I think that as one. Mark?
Yeah, thank you very much. And thanks, Mattia, for a great presentation. So I was just curious, I'm not really coming from this this kind of particular field. So I was just wondering whether maybe you could give an example, you know, like a hypothetical example. So for example, I don't know, like the US tech industry or the banking sector, you know, and kind of, you know, explain a bit on with that example how what the model tells us, you know, kind of how competition and so on play that, and where you would like locate it in your chart that you showed us at the end, maybe. Thank you.
Yeah. So should I wait and collect other questions, or do you want me to reply now? What you prefer?
I think we can. I think we can do one by one. Yes. Go ahead, please, Mattia.
Well, I showed you at the very beginning actually some examples in which the buybacks have been announced by firms. So here you have both technological companies and more general companies. I mean, stemming from the food industry, but actually they also operate minor in other kind of industries. And what we were thinking about is in particular about these firms like Apple or like Amazon, like Tesla, which are listed, and during the past years they have been they've seen a decline in the ownership of the founders and a huge increase in the ownership of banks, of startup founders, but also let's say venture capitalists, which they provide funds as long as the price to earning ratio continuously increases. But when the price to earning ratio starts to decline, they can stop the funding. Now, in the case of Apple, at the moment, we didn't see, even if the decline in R&D is substantial, we didn't see an effect of the investors running away from Apple. But what we have seen, it's a huge increase in the share buybacks and a decline in the amount dedicated to R&D investments. So at the moment, Apple is still one of the market leaders in the computer industries, but one might also expect that if this is the trend and this continuously goes on, Apple might lose this leadership and eventually might even go out of the market in the long run if not sufficient resources are dedicated to R&D. There is also Philipp here, which is a co-author. I don't know if you want to specify something more on this, or feel free to intervene.
In the meantime, there is a question by Sylvain. So Sylvain, please go ahead.
Hi, Mattia. Nice presentation. I remember seeing the kind of first version of this with Philipp and Herbert in Paris. It's nice to see how it's kind of expanding. I had a question about one of the triangle plots that you did. I think it was the second one. Could you go back to it?
Sure.
Yes, it's that one, I think. So here I'm a bit, I won't say puzzled, but I have a bit of a question mark with regards to the interaction of the two the two red and blue lines, basically, which seem to essentially follow each other very, very closely and seem to kind of overlap. And, you know, for some cases, it's a bit stronger for one and a bit for the other. And if you look at the triangle plot itself, and you look at the dark green area at the bottom, there seems to be some branching. If you just to the left of that.
Here?
Yeah, so there's a little branch that kind of seems to go upwards and then dissipates. And a bit further to the right, there's a bit of kind of, you know, I'm wondering if there's maybe some chaotic dynamics that's happening here, where actually what you've got is you've got much, much more complexity in terms of how these things kind of bifurcate. And because you're kind of averaging and stuff like that, you're not necessarily seeing that. But in some local areas, the effect might be strong enough to detect, you know, you might have multiple branching. Because that would be something that I expect if you've got two curves that are kind of overlapping the way they do on the right. So I think that's something you might want to explore.
Yeah, I fully see your point, and thank you actually for this one, because we didn't investigate in this direction. But for sure, what we can do is to study like the Lyapunov exponents of our system, and try to see whether there is some kind of chaotic or quasi-chaotic dynamic for specific areas. So we might try to focus on this area to obtain some dynamics of the parameter. I mean, we can get the time series of the parameters, and then we can apply some test. Maybe
because that'll also have some implications in terms of policy, right? Because there might be some parameter configurations where the policymaker doesn't want to go because the dynamics become very unpredictable.
Yeah, that's true. That's true. That can be actually one of the dark corner. Let's say Blanchard was speaking about for macro. This can be the dark corner for industry dynamics if you want.
Mm.
And yes, thanks a lot for this comment. Actually, it's very useful. I think that what we can do is really to extract the time series that we are interested into here, since we also have a very long run simulation, and to perform the Brock, the BDS test in order to investigate whether chaotic dynamic is happening.
Okay, any further questions? We're towards the end of the seminar, so but I think we might still have time for a quick question. So I actually had a quick one, Mattia. So something I might have missed is whether there's a positive role of short-term investors in this model. So typically, I would think of short-term investors as someone who's bringing maybe liquidity to the market that nobody else could bring, so that no other kind of investor could bring. So speculators, basically. So they also have a positive, if you want, maybe not socially optimal, but positive function. So is there such an element in this model, or should I think, okay, sure, it's intuitive that they have not a beneficial effect because they're not seeking any sort of long-term positive effect?
Yes, I agree with you. And indeed, this is the new version of the paper which we are carrying out. I mean, what do we have here? And the results that we provide, the unique thing that basically is static is the governance structure. So we are studying the governance structure for different parameterizations, but the governance structure within a simulation, it's static. So once we have determined that the short-term investor have 20% of the control, they have 20% of the control. Of course, in the reality, this is much more complex. And so what we are trying to develop now is we are giving a feedback from the results of productivity growth and the share price, feeding back into the decision of the short and the long-term investors.
So endogenous corporate structure, basically.
Exactly.
Okay.
And I think that this might go into the direction of your point, because then the short-term investors might also move from one firm to the other, moving their liquidity to the firm which becomes most profitable from one period after the other.
Yeah, that was exactly my point. Okay, thank you very much. Okay, so I don't know whether there's any other question, but if not, let's thank Mattia Guerini again for his presentation. So Mark also pointed out that today is the 1-year anniversary of the ABM4Policy series. So thanks to everyone who's been part of the community and participated to the seminars. So please, feel free to keep inviting your colleagues so that the community can expand. So we have the next seminar planned in 2 weeks. It will be Pierre Georg talking about social learning in a network model of COVID-19. So again, very, very pressing topic. And I think with that we can close. Thanks everyone, and see you in a couple of weeks.
Thank you.
Bye.
Bye bye.
Thank you. Bye.
Thanks. Bye.